All right, welcome to The Explainer. Today, we're going to pull back the curtain on something that sounds, well, kind of intimidating, but is actually the key to understanding any business. We're talking about the income statement. Think of it as the financial story a company tells, showing you exactly how it made or lost money. So let me just start with a question for you. If you had to give a company a report card, an actual grade on how it did last year, how would you even begin to do that? What's the one thing you'd look at? Well, the answer is actually pretty simple. You read its income statement. And this isn't just some boring, dusty accounting document. No way. It's a powerful tool that tells a really clear story about how much money came in the door and what it cost to get that money. So here's how we're going to break it all down. First, we'll look at the big picture. Then we'll start at the very top, the total sales, and follow the money all the way down, subtracting costs until we hit that famous bottom line. And stick around for the end, because I'm going to show you a trick that analysts use to really see what's going on inside a company's strategy. All right, let's dive into Section 1, the financial story. You'll see that at the heart of this whole thing is one incredibly simple equation. Okay, when you boil it all down, the income statement is built on this one powerful idea. Revenue minus expenses equals net income. That's it. Everything else we're going to talk about just flows from this simple concept. It's the story of a company's profit or its loss over a set period of time, like a quarter or a whole year. So let's start at the very top of that equation, right at the beginning. Section 2, the top line. You'll also hear this called revenue or sales. It's pretty straightforward. This is all the money a company brings in from selling its stuff. Now, here's a super important point, and it trips a lot of people up. Revenue is not the same thing as cash. See, most companies use something called accrual accounting. All that means is they get to record revenue when they've earned it, not necessarily when the cash hits their bank account. So if they deliver a product to you today, that's revenue today, even if you don't pay them for another 30 days. It's all about when the value changes hands. So it's not a free-for-all, right? Companies can't just claim revenue whenever they feel like it. There are rules. In fact, accountants follow 4 key criteria. You got to have a contract, you have to have delivered the goods, the price has to be locked in, and, this is a big one, you have to be pretty confident you're actually going to get paid. This whole system keeps companies from, counting their chickens before they hatch. Okay, so we've got our big starting number, total revenue. Now for the really interesting part. We start subtracting things. This next section is where we see how that huge sales number gets whittled down step by step into what the company actually gets to keep. To make this a little less abstract and a little more real, we're going to follow the numbers from an actual company. Let's use the income statement for Kraft Foods from back in 2009 to see how all this works in the wild. And here we go. This is the top line. Back in 2009, Kraft brought in over $40 billion in net revenues. That is a massive number, right? But remember, that's not profit. Not even close. It's just the total sales they rang up. And here's the first big bite out of that number. To make that $40 billion in sales happen, Kraft had to spend almost $26 billion on what's called the cost of sales. This is the direct cost of making the products. The cheese, the crackers, the packaging, the people in the factory, all of it. So you do that simple math, revenue minus cost of sales, and you get your first level of profit, $14.6 billion. This is called gross profit. You can think of it as a way to measure just how profitable a company's core products are before we even think about things like marketing or CEO salaries. But wait, we're not done subtracting yet. A company doesn't just spend money making its products, right? It also has to pay for marketing, for its headquarters staff, for research on new products, all that stuff. Once we subtract those costs from the gross profit, we get to our next milestone, operating profit. This number tells you how profitable the company's main business really is. Okay, we've subtracted the cost of making the stuff and the cost of running the business, and that brings us to the grand finale. Section 4, the one, the only, famous bottom line. This is the number that really shows what's left over for the owners of the company. This is it. After you've taken out every single possible cost, the products, the marketing, the interest on debt, the taxes you pay to the government, whatever is left over, that's net income. This is the bottom line everyone's always talking about. It's the final grade on the report card. It's the actual profit. And there's a good reason people are so obsessed with this number. As this quote says, for a lot of analysts, net income is basically the most important single number for judging how a company did. It's the ultimate scorecard for profitability.
But a multi-billion-dollar profit number can feel pretty abstract if you're just a regular person who owns a few shares of the stock. That's where earnings per share, or EPS, comes in. It's simple. You just take that total net income and divide it by the number of shares out there. Suddenly, that huge profit gets translated into a simple per-share number that any investor can understand and track.
Now, for our final section, I want to show you a really cool trick that analysts use to read between the lines. This is how you can compare the strategies of two completely different companies, even if one is a giant and one is tiny. Take a look at this table. It's called a common size income statement. The magic here is that instead of showing dollars, every single line is shown as a percentage of sales. This is an awesome way to compare companies because it completely removes size from the equation. You can immediately see how two companies stack up, pound for pound. And when you do this, the company's strategy just pops right off the page. Look, you can see that Company A and Company C are playing the same game. They spend a ton on R&D and ads to support a high-margin product. Company B? Totally different story. They're a low-margin business that probably competes on being the cheapest. This lets you see the business model, not just the dollar signs. So at the end of the day, the income statement is a story about the past, about what's already happened. But if you know how to read it, if you look at the trends and see the strategy hiding in the percentages, you can find some really powerful clues about where that company is headed next. And that right there is the real power of understanding this financial story.